Thank you for the stellar session, Puneet and MR. Looking at life/entrepreneurship as a marathon. Sprint, rest, assess strategy, sprint again. I loved it absolutely. The session coming up is a very special one, and this has been powered by the Indian Angel Network. We would like to thank them for their support as always. Valuation versus, Value versus valuation, powered by IN. The stellar speakers for this session are Bala C. Deshpande, founder and partner, MegaDelta Capital. Bala started her investing career as a director investments in ICICI Ventures in 2001 and in 2008 she joined NEA at a general partner level to set up and head their India practice. Next, we have Rehan Yar Khan. He's the managing partner at Orios Venture Partners. Rehan has been an entrepreneur since 1992 and has himself built three successful companies. Rehan is also the founder of Indian Angel Network's Mumbai chapter, co-founder of Angels India, a Thai charter member, and on the executive council of IVCA. And our moderator for today, Mr. Sanjeev Bikhchandani. He's the founder of InfoEdge India, the company that owns Naukri.com, 99acres.com, Jeevansathi.com, and Siksha.com. In addition, it has invested in approximately 50 startups, including Zomato, Policy Bazaar, etc. Sanjeev has served as the president of TiE Delhi-NCR chapter and as a member of the Global Board of Trustees of TiE. In 2020, Sanjeev was awarded with the Padam Shri Award. I really look forward to this session. Bala, Rehan, and Sanjeev, over to you guys.
Thank you for the introduction, Vatsala. Hi, Bala. Hi, Rehan. Welcome.
Hi.
I really look forward to this discussion. Now, in perfect markets, valuation and value would always move together and coincide. But Bala, I'll ask you first, and then Rehan. Why is it that value and valuation diverge, and what is value and how is it different from valuation?
Yeah, so I actually, as a growth equity investor, I'm normally a taker of this dissonance that is created by early stage investors like yourself.
No,
But
Rehan, Rehan, no, Rehan, don't blame him.
couldn't resist that. But yeah, no, I guess I guess the reality is that when we all were doing our management and we did the Damodaran course on valuation. It was a very CAPM model, and it was very related to a lot of uh, financial metrics that were there. But I think the whole world has changed. Businesses have changed. The digital economy is resetting the rules, and therefore it's a very hard question that you ask: what is value, and what is therefore the correlated question: what is valuation? According to me, today the value that in the eyes of the investors have changed towards and leaning towards the intangibles. And what do I mean by the intangibles? The intangibles are things like how innovative or disruptive that play is, how much of it is it talking to the new world, the new target audience, how much of the value, how much of value are you going to ascribe to leadership and deep differentiation. So there are a lot of intangibles that have crept into the value equation, and they are not necessarily definable across sectors in a standardized way anymore. So that's really the way I decode the current market. The same valuation the value and the valuation dissonance that has come in into, say, consumer tech today is clearly attributable and ascribable to leadership, to differentiation, to brand value, which today people are saying that if you are a Swiggy or a Zomato, you are the default to go to for food delivery, and this there is a latent potential brand value that cannot be displaced easily by enormous amount of capital even. So that's the way I look at understanding the value drivers for today's valuation. That this discomfort in terms of the is valuation is the valuation appropriate for the business that is being funded, both in terms of revenues and EBITDA, is no longer a relevant question.
So, Rehan, now Bala has blamed you and me for paying too much, and therefore she's paying even more. And so valuations are climbing. Uh, what's your defense, and what's your reason for paying the valuations you pay?
Well, actually, Sanjeev, as you know, at early stages, valuation is not very material to us. Of course, it does matter. I think it's at our early stages we look for great teams, we look for great opportunities, and we invest. And you invest with the hope that this company will grow 1,000 times from where you've invested, and that will create a lot of value. It will create a lot of valuation as well. But I think the challenge is more for later stage investors, and that has been the challenge of late. See, your question is a very loaded question, and what it implies is that valuation has run ahead of value. This question would not have been asked had it been the other way around, or even if the two were equal. So, what has caused? Let's here's my take on what has possibly caused valuations to run ahead of what is the real value of the business. One, as we know, has been all the monetary supply which has come into the world in the last 2 years. I've seen stats which said that the amount of money in the world has doubled since the pandemic started. That means central banks have just released that much more money into the system, and that has certainly had weird effects, right? And valuations have probably run ahead of value, and those are resetting. And the other reason this question is being asked is because those are resetting, right? If those were not resetting, everybody would be happy. Um so those are resetting, and valuations are coming down, and then thus people are asking, what is the real value? Where is this going to stop? Right? Where are the two going to come and meet? I don't think any of us here know that answer, but there seems to be a sentiment right now that valuation is ahead of value.
That's a sentiment among some investors, perhaps, who are wanting to come in later rounds, but are not willing to pay the price they might have been willing to pay for that same business 6 9 months ago.
Yes.
But I think entrepreneurs in their heads have still stuck on the same valuation that they were expecting, and they're not really budging, and they're disappointed. Is that correct, you'd say?
Yes, so the trickle down, as you know, Sanjeev, Bala, to the entrepreneur lot and to the early stage investor lot is a little slower, right? So the people who first get the shocks are your late stage investors. They invest at, let's say, I'm just taking a number here. Let's say they invested 100 rupees, and suddenly the price, in the stock markets of comparables goes and becomes 80 rupees, right? And if you're a private investor, then you're like worried. You're like, oh my God, what's happening over here? So they get the shock first. That shock then reverberates, to their ICs, who then pay lower prices for other investments. That then comes to mid-stage investors. It comes to early-stage investors, and it starts going down to entrepreneurs. And entrepreneurs may have also gone and raised money at a certain price, and now they may be looking at a down round. They may be looking at a neutral round. So it's a hard bullet for them to bite. There are ESOPs at stake. What do you go and tell employees that your ESOPs are reducing in value? So entrepreneurs are fighting that, right, constantly, and it makes it hard for them to swallow. Of course, the reality of the market at some time makes people adjust. There are news reports coming recently of one or two companies now willing to accept down rounds. There was a prominent company yesterday, late stage company, that has been reported to be willing to accept a down round. So I think that's where we are today.
Yeah, so I think Rehan has put the points well, but I'd also like to add to one of the points which is related to the capital supply point that he made. The reality is also there is a lot of capital flocking, right? I mean, whether you take the US market or you take China or India, uh, capital tends to flow to fewer companies today than ever before, right? So, therefore, then the inordinateness of the valuation of those companies that are able to raise a large part of the capital that is available in their sector, that also adds to this gap between valuation and value. And then to reverse the point that Rehan made, which is going up from late stage to down to this. So if you have raised $100 million, and we have had these celebrated examples where a company hardly doing a couple of crores of revenue raises 100 million overnight, then there is a sort of snowballing that happens, and every other entrepreneur in that sector says that, hey, look at that, my business metrics are better, my business model is better, so why shouldn't I get that? So there is some amount of that catch up game that also starts happening. So and a lot of the investors tend to flock to the guys who are capable of raising a lot of capital. So it's a little bit of self-inflicted pain, if I may say so.
So it's a game in which I mean both investors and entrepreneurs are participants, and equally so. I mean, the entrepreneur is demanding a higher valuation, and if the investor will pay it, then that's how it works, right? But so I think it must be really hard to be an investor right now, Bala, Rehan. That look, you can't get a deal at a lower valuation because there's competition from other investors. At the same time, you think the perhaps is overvalued, and what if the company doesn't get the next round at a higher price because markets are correcting around the world globally, at least public markets, right? And public market correction will cascade into private markets. So it must be really difficult for the two of you right now to figure out what's the right valuation to go into a company, or should I walk away? You walked away from any deals in the last 6 months on valuation, either of you, Bala, Rehan?
We didn't.
Yeah.
Sanjeev, we don't care for valuation at early stages. We
Okay.
only care
So,
for great teams.
Okay, got it. Got it. Now, Bala, you were saying?
yeah, so I think in the mid market, I think there is one added element that comes in our industry. I think a lot of our industry is a little bit of a barbell, so the middle is quite empty. So we do in many sectors other than consumer and like say healthcare, etc., etc. By the time it comes to Series B plus, there are fewer investors that are willing to pick up the ball and run, and therefore we don't get really very troubled. Let's say in the middle of the segment, right, where the company has done reasonably well, has got a promise of the future, the valuations have tended to remain reasonable. It's the really the sectors where you have a FOMO, really, where this issue comes up, like any consumer but D2C brand today that I see. I really have this dilemma, D2C is really the darling of the market today. There is lots of money pouring in. People are raising money at a greater and higher valuation increasingly. But when is this party going to end? And am I going to am I going to get the wrong end of the stick coming in now as a mid-stage investor? So your point is absolutely valid. But the only nuance I'm bringing to the table is that mid market investing, other than consumer, is reasonably easy as compared to. So even if you take enterprise tech or even traditional sectors, it's not so bad. It's in the consumer tech space that we have this real challenge, and it's almost damned if you do and damned if you don't. And that's really where we rely then on looking at portfolios of companies like Rehan's, like Fireside, etc., to really make up our mind in terms of where we want to participate in this
So
space.
what I'm hearing is that at early stage, Rehan is not so valuation sensitive, and therefore it's not really that valuations have corrected there. In the mid stage, you're saying valuations are reasonable everywhere except consumer, and they have been so for a while, and there isn't that much competition. So what I want to move on to is, see, all the conversation, all the buzz, all the word of mouth, all the social media, all the journalism, articles by journalists, everybody talks about only who raised how much money at what valuation and how many unicorns are there, right? Nobody talks about how are sales growing in the company, how far away from profit, what's EBITDA margin like, uh, when will the losses, end, and that's real operations, right? And ultimately, value for shareholders is perhaps appreciation and valuation, but ultimately in life you'll be valued of a profit multiple in the very long run, right? So, do you think the discourse will now shift to company operations and sales growth and profit, or it'll still be headlines will all be about valuation and fund sizes, size of rounds? Rehan?
I personally don't think it'll shift, Sanjeev, because companies are loss making, so PR departments are not going to be churning out financial numbers.
But that
Uh,
means journalists are not doing their jobs, right? If they don't
well,
investigate.
PR departments are feeding people, right? They're not feeding them financials because the financials don't look hunky dory when reported in the mainstream media. Listen, we all know as investors that the reason you have losses is for market development, right? I mean, if you look at accounts, the way accounting works is that if I spend on market development, it goes into my P&L. If I spend on plant and machinery, it goes into my balance sheet, and that doesn't become a loss, right? So in the good old days, when you had asset-heavy businesses, or no, why in the good old days? In asset-heavy businesses, you spend on plant and machinery, it's still cash flow, but it doesn't go into your P&L, so your P&L looks healthy, even though you have a drag on your cash flow. So I would say the venture capital model is more cash efficient, even though it shows losses. But I'll tell you where there is an issue. I think the issue is how deep is the Indian market, right? How many consumers do we really have? I mean, we talk about a 1.3 billion market, but is it actually even more than 40 million? Is it more than 35, 40 million in terms of 95% of the products? I'm not talking about communication products like WhatsApp or social media products, which can be consumed. And there, I think the question of value versus valuation is coming into play, because possibly investors are investing for a market which is perceived to be much deeper. Entrepreneurs are planning for a market which is perceived to be much deeper, and that market seems to be hitting a ceiling, right? And there is where I think is the issue, if you ask me.
So what I'm hearing you say is that, look, there's valuation in the market, but is the market capable of delivering enough customers that will create value, that much value? I mean,
Absolutely.
it remains to be seen. There's some doubt there. Bala, your
Absolutely.
comment.
So I don't think, I mean, I've been investing now for 22 years. I don't think we ever go away from the questions of the inherent strengths of the business model or the market position of the company that we're going planning to invest in or evaluate. Yes, it does seem from a PR perspective, from the media perspective, that we don't. But I do think that there is something that we all look for, which is like I go back to my first point. It's an intangible that may not translate to numbers immediately, right? There may be something in the business model that is a winning model that I feel will survive the onslaught of competition. Will increase the depth of the market, even if today it's limited to Rehan's point. So I need to see that something which is not necessarily uh, uh, translatable into a valuation metric today. So just to let me elaborate that. I mean, if you look at pharma companies, right? This is the classic trade-off between how much you invest in R&D for new molecules, which are not going to be visible in your P&L, but they are very important for your future growth and future market position. So it's never off the table, so I disagree with that. I think I have seen how Info Edge Ventures work. It's never off the table, right? It is even if, no matter how early stage you are, no matter how rich an angel you are, it's there is an underpinning of business metrics that comes in into every conversation. Yes, it may be a matter of time that I'm how much time I'm going to willing to give as an investor before that metric is the one that is the where the gap between value and valuation may creep in. So I, as an angel investor, I'm saying next 5 years I don't see profit on the book. I'm fine with it as long as there are enough other capital providers who are willing to journey along with this company for the next 5 years before we get to that pot of gold in terms of numbers.
Got it. But okay, so let's get specific now. We've had a very general conversation so far. So Rehan, can you take a specific company which you went in early, you've done the journey, it created value, and you got a great valuation, and you exited, or perhaps it's very clear evidence that look, you've really done well, and that company's done well. And let's take that case study. Can you name a company?
Sure. Well, I mean, let's take the case of FarmEasy. FarmEasy is a company which has received its DRHP. It's got its DRHP approved from SEBI and is all set to IPO. And this is a company we had, entered at the seed round. It's a huge space, as you know.
So seed round means before it launched or after it launched?
After it launched. After it launched.
And you were the first institutional check there?
First institutional check.
So
Yes.
what did you see in that company?
We looked at several companies, Sanjeev, so first of all, we wanted to invest in this pharmacy space because in India the chemist shops are not very deep. I mean, all of us who live in metros think there are a lot of chemist shops, but the minute you go outside of the big cities, you don't have chemist shops, and even within cities there are issues, right, of stocks and spurious products and things like that. So we thought it's an immense space for investment, digital, and we looked at a number of companies. Sorry, you were saying something?
No, I was thinking, so when you went in, was it doing revenue? And how much revenue?
I mean, they were doing very little. They were doing like 1,000 rupees a month.
And probably making, negative margins, right?
I mean, 1,000 rupees a month, it was like nothing. Yeah, so
Yeah.
huge amount of. Yeah,
So what did you see in that company, and you gave a valuation which was okay with the entrepreneur, and you obviously saw some future value, right? There was very little current value.
Absolutely, yeah. You can't sit and do a DCF model or anything like that at that stage. People have often said early stage investments
So
are a good.
क्या दिखा आपको उस company में? What did you see?
The two things that we usually look for, right? Big TAM, great team, right? We call it the two T's, TAM and team. So TAM was huge, massive. Everybody needs medicines, undersupply of medicines across India. Space waiting to be organized in the US. You've got chains like Walgreens, which have organized the pharma space. In India, there were no organized players. You only had, small chains and mom and pop shops, massively underpenetrated. Very good team. The three boys who did it, two of them came out of, the medical fraternity. One was a doctor, one's dad was a doctor. So, they knew the business. And in fact, they were even running a small shop in one of the hospitals that was selling medicine. So they kind of learned about retail. We felt this was the team that could do it. And yes, they did do it. Right. They got the hardest part right, which is managing the supply chain. Right. As you know, there's so many SKUs in this business.
So you pay valuation ahead of value, and sometimes it works out and sometimes it doesn't. But some companies do well and some don't. So essentially, you have some sort of framework to assess whether or not this will actually go on to create the value that will justify this valuation and give me a return maybe 3 years from now, 5 years from now, 10 years from now. Right?
Yes.
So you are in the business of paying valuation ahead of value and hoping and working with the company to make it happen. Right? Bala,
Yes.
Any one company other than Naukri where you've been there for a long time and you.
Yeah, so I'll choose a company which probably seen, a classical mid-market funding, the company called FirstCry. So, basically, years by the time it came to us, it was already in revenue, uh, loss making, of course. But here's what the entrepreneur was dealing with, right? It's still very small, but everybody whom he went to, every investor he went to, he said that, Amazon and Flipkart are going to eat you for lunch, because finally, what is it? It is a vertical which is catering to children less than 8 years old. How hard is it for an Amazon to really, keep coming to this, right? So for us, it was about also decoding as an investor, what why would a mother and baby vertical in our country do well, and why Supam, of course, like Rehan pointed out, team's a big thing, because even to take on an Amazon and a Flipkart with their kind of capital, you need a very, very strong entrepreneurial team. So the team obviously checked out extremely well. But here's how we decoded it, right? There is a big space um, for a mother and baby vertical, because the mother as a consumer is very discerning. She wants quality, she wants variety, she wants at a price that is affordable to her purse. So, basically, a lot of business understanding is what we bring to the table to essentially pick, because when you're coming in at the mid market, the biggest risk we run is if the growth curve starts to flatten, or the cost of growth becomes is too prohibitive for the amount of capital that the company is raising. So we actually spend a lot of time in analyzing the growth drivers of the company that we are entering in, because for us, we don't see searing growth like the early stage guys, unless a lot of the variables have already been ticked and factors are in place for a good solid growth. So we made a 5x on that. The company is going to go is just finishes around now at a 3 billion. So actually we are very happy with
You
that
made
pick,
5x. You
because
made 5x in how much time?
4 years.
Okay, got it.
So
Got it.
for us, it's the risk return reward which needs to fit in well, which is driven by how much of growth, leadership, etc., that this company can deliver in the time frame, shorter time frame that we our kind of funds typically operate on. So yes, we are more mindful of valuation, because these are these in this space, in the mid market space, you tend to be punished quite severely if there is no growth, and our portfolios tend to be a smaller basket as compared to the early stage investors. So we have to be far much more uh,
You got to
particular
get
about having.
you got to get very few companies wrong,
Yeah,
because
that's
on the upside, you don't get 1,000x because you've not gone early enough.
that's right.
Got it. Got it. Got it. So,
Though there are some IPO stories that emerge, and they do tend to bust the ceiling of 4-5x, uh, but that's okay. But the loss ratios are lower.
got it. So coming. So Rehan, if it's not confidential, how many X are you sitting on in FarmEasy? I won't ask the amount, but the X.
Well, Sanjeev, I'll share with you another detail. When we invested, the valuation was somewhere around, I think, $7 million, and now the company last media reported valuation was $5.6 billion.
But there's been dilution since then, right?
There has
So
been dilution since then, of course,
yeah, yeah.
but you can imagine it's quite a handsome multiple.
So okay. So here's I'm putting an issue out there. Uh, Look, do you think it's possible that some investors, and not the two of you, but some investors, uh, tend to nudge their portfolio companies in directions which are towards getting a higher valuation in the next round, as opposed to running a stronger business? And sometimes there's a divergence there, because if the incoming investor is saying, "Hey, I'll value you on GMV, I'll value you on top line, never mind the burn," right? then companies who entrepreneurs who want a valuation and the next round raised at a large round raised will follow that signal, right? So have investors also given wrong signals? And tomorrow, if liquidity corrects, you will find companies get stuck in a trap where they can't migrate to better unit economics in a hurry without.
Yeah, I mean, I think what happens, Sanjeev, is that the availability of money and the availability of money at good valuations, which means cheaper money, or allows founders to think about expansion quite aggressively, right? And dominating markets, and that's what they're looking to do, right? So it's all about trying to get cheaper money, and that's why they're going in for higher valuations. And everybody on the cap table tends to be supportive of that. Um, the issue comes, like I also alluded to earlier, is that sometimes if the market doesn't materialize, you believe that the market is X deep, but the market turns out to be Y deep. And you have to do, some of the things that Bala alluded to, go horizontal, and that starts creating issues, right? Or the deeper market becomes very expensive to farm, and your cost of acquisition starts going up. That starts creating issues. So yeah, everybody wants higher valuation because it's cheaper capital, and nobody's going to turn down a term sheet and say that, oh man, this valuation is too high. I want to take it for 20% lower, right? Because I'm worried about my next round, maybe a down round if I take it so high. I mean, I've hardly ever. I have seen one entrepreneur do that. I have seen one entrepreneur do that, and I thought he was very sensible, right? He said, "Listen, I don't want to get ahead of myself over here in case I have a lot of pressure on my next round." And I thought, wow, this is great. These people are thinking of continuous value creation versus opportunistic and round to round value creation, right?
But that's rare, right?
Very rare. That's 1 in 60 companies.
Hmm. Okay, what's your view, Bala, on all the public market corrections and the IPOs that happened, and and not just in India, overseas, right? And they're now facing pressure.
So, this forever. In fact, when I was with the US firm, there was this whole new emergence of what was called as private IPOs, which basically meant again a lot of money that went into the to some really promising tech companies. And because my earlier firm was very enterprise tech oriented, which was an uncommon thing, right? Earlier everybody said yes, if you're a Dropbox and you're getting these kind of 9 billion valuation, that's fine, because it's a consumer story. And in comparison, we had a company called Box, which was B2B, which got valued at about 2 or 3 billion, circa that number. So, but before these rounds happened, there was a lot of investors who erstwhile never participated in the private space, whether you call it a pre-IPO round here in India or maybe 2 years before the IPO, all of them, and I'm talking about pension funds in US as well, who wanted a piece of the pie before they went public, right? So there was a whole lot of valuation build up that happened in the private IPO space, which is also the phenomena that occurred in India, if you ask me. And so there is this hunger for these new age digital tech, if you pick the word, companies in the public market, investors who are dissatisfied with the allocations, that they get in the public market. So, do I see that? And therefore, of course, once you have set that benchmark and you're going public with the investment bankers, knowing fully aware that this is what you're marketing, you have already created this entire appetite around the paper and a valuation benchmark around the paper, and then you went public, right? Which does not really take into account the post listing realities, where one biggest where there has been a there is a big phenomena that happens that I, as a public market investor, I can trade out on you, right? That doesn't happen in private markets. It happens in public markets, and therefore you see price volatility, you see price corrections, and the public market is always very, very closely linked to external factors like war or any other event. And so it's not really a bit of a big surprise that what has happened to some of the last year's stocks. The question really is that um, even if there is correction this year, uh, you as a private investor or a retail investor, are you able to hold on for the next 2 3 years, continue doing that, right? Because fundamentally, if you like that company and the business model is something that you endorse with your investment, you should, continue being invested in that stock. So corrections are par for the course once you're listed. Volatility is par for the course because of, like I said, as a public market investor, as a mutual fund investor, I hit I hit my risk parameters. I hit the gate. I have to be out. So I'm not really worried about it. But yes, but if the question was there an overselling last year? I think so. But like I said, water finds its level. There was demand, and therefore the supply, met an equilibrium, and therefore the pricing happened.
Rehan, your comments.
Well, this is more around late stage, so I'm less qualified to, comment over here. But yeah, I mean, certainly external. Now, I'll tell you where early stage investors are hit by late stage, right? IPOs are stalled. We actually have a number of IPOs that were supposed to go out the first 6 months of this year, and it looks like they're going to get delayed, right? They are already delayed. We had four of them actually, and that's where I think early stage investors, need to be aware of what's happening at late stage. And I'll tell you what the extra negative kick over here is that just before these guys all went to IPO, they converted. They had to do bonus issues, right, in order to reduce the share price, and all those shares have now become STCG, and unlisted STCG for 2 years. So instead of having LTCG shares, all of us early stage guys, and in fact all the investors on the cap table are sitting on STCG shares, 95% of them, because of the bonus issues. So there are these kind of late stage factors, macro factors, like she said, war, inflation, and correction of late stage stocks, of listed stocks, which is affecting early stage people like us. And normally I would never think of public markets, because I was like, okay, I'm an early stage investor. I look at the two T's and I go and I invest. But now I'm watching the markets. Of course, what can I do? There's nothing I can do about them. I just have to watch. But we are watching.
But public market valuation matters, therefore, even for you.
It does matter.
Okay, we are out of time, guys. Any last comments on any one piece of advice you want to give, Bala, to founders, who are early stage founders, on focusing on value or valuation or both, and if so, how much?
Yeah, so I didn't answer one question on whether we encourage investors to encourage founders to go to investors to give a high valuation. I completely agree that if what I find it with Rehan, if you're getting the term sheet, you're not going to say no. But here's what I definitely like founders to do, right? Do not underspend on your companies in today's world. So do not be dilution sensitive in today's world, because you cannot assess the kind of opportunity cost you run by not raising capital in time.
Or
Valuation is.
if competition raises, or if competition raises and
I'm
you
sorry.
don't.
Absolutely, yeah. So you need to be extremely smart about your capital raise in terms of timing, in terms of spending the capital that you raised into that opportunity, into your company in a way that maximizes the bang for the buck. Because unfortunately, today's world is not giving you time. It's not giving you talent. It's not giving you any luxury where you can say that I can fight this battle tomorrow. I'm not saying that therefore there is no time, absolutely, but we are talking about much lower time frames than ever before
Thanks.
to win.
Rehan, last comments, advice on to entrepreneurs.
My advice here, I'll tell you, my current hero is Falguni, who went in IPO owning 54% of her company. That's my hero out there, and that's something I want to point out to founders, that be careful with your business, because a lot of people going out in IPO ending up with 5%, 7% of their company. It's a slightly different from your view, Bala. I would say don't go with dilution at all cost. Build a business which has great internal cash flows and an internal cash engine, so that you are making money, and as a consequence, your need for outside money is lesser. And there are certain simple strategies around this, like making one city into a profit center and using that as a cash machine. I think people should think of the end game of how much they're going to own
That
when they.
that is undeniable, Rehan. But I think the question is how many such business models really are available today. And I am a big believer of cash flow. So I'm sorry, I'm not contradicting you, but there is a role of capital that is playing an increasing role today than ever before. Falguni had raised a lot of small rounds, and she got a lot of angel investors to back her. That's not how many people. I mean, she's extremely good. Of course, she's a friend, but it's not necessarily how many you know, uh, capital raising functions roll out in this country.
Guys, I have to interject here. We have overshot by 12 minutes. Uh, I think fascinating conversation, and thank you so much. The issues are out there; they remain unresolved. I don't think it's a very confusing world out there on value versus valuation. But fundamentally, if you're getting money and you need it, take it, right? And we'll figure out the valuation data.
Even I'll take it, Sanjeev. Please give me some of your big net worth. I'll take it.
Thank you, and bye bye.
Thank you, Sanjeev, and thank you, Anupriya. I see you at the bottom, relaying everything we are saying. So thank you
Oh
very
yeah,
much.
thanks, Anupriya.
Thanks, Rehan. Thanks, everyone. Bye bye.
Bye.
Bye.